Welcome to your investing journey. You've saved up some money and now you're considering how to grow it. The investment world is vast, with many options like stocks, bonds, real estate, and digital assets like cryptocurrencies. It can be overwhelming, but the ultimate guide to investing for beginners is here to simplify it for you. This guide starts with the basics of investing, explaining the fundamental principles that guide the financial world. Next, we'll explore the intricacies of stocks and shares, essential tools for growing wealth. We also address a common beginner concern, the fear of losing money, offering practical strategies to manage risks. Lastly, we'll introduce you to fast lane investing, a more dynamic approach for those seeking accelerated wealth building. This guide is your roadmap to help you confidently navigate the investment landscape. Let's begin this exciting journey of turning your savings into opportunities for growth. Investing is essentially about making your money work for you. Imagine you've saved $1,000. You could stash it under your mattress or in a basic bank account, but there's a catch: inflation. This economic factor diminishes the value of money over time. For instance, today, your $1,000 might buy a MacBook Air. Yet, with inflation, the same laptop could cost more in the future, reducing your money's purchasing power. That's where investing becomes crucial. By investing, your money doesn't just sit idly. It grows, helping you counteract inflation's effects. But how does money grow through investing? It's about buying something that increases in value over time or generates income. Take a house, for example. Buying a home can make you money in two ways: rental income and potential appreciation in value. If you kept that money in the bank, inflation would erode its value over time. Houses are a tangible example because of the concept of rent. However, other assets don't offer this straightforward income. In many cases, you're banking on the asset, increasing in value over time. Stocks and shares, which we'll discuss more later, are a notable exception, as some pay dividends akin to rental income from real estate. There are many asset classes like stocks, shares, equities, bonds, hedge funds, index funds, and even unconventional ones like fine art, watches, and cryptocurrencies. The latter can be a roller coaster, as recent market crashes have shown. But don't worry, we're here to simplify things. For beginners, stocks and shares are a great starting point. They are more accessible than significant investments like real estate and generally less risky than volatile markets like crypto. You don't need a fortune to start, and you don't need to be an accredited investor, as required for some complex investment vehicles. In the following segments, we'll dive deeper into how you can start investing in stocks and shares, a practical and attainable way for everyday people to grow their wealth. Investing in stocks and shares means buying a piece of a company. For example, if you buy Apple shares, you own a small part of Apple. It's not as direct as purchasing from their website. You need a broker, a middleman, to facilitate this. eToro, for example, is a popular platform in the US that allows you to invest in various companies. There are two main ways to earn money: stocks and shares. First, you can profit from the appreciation in the stock's value over time. Buy a share at a lower price, and if the company does well, you can sell it at a higher price later. Second, some companies pay dividends, which are portions of their profits shared with shareholders. Owning shares in dividend-paying companies can feel like receiving rental income, as you periodically receive money just for holding the stock. But how do you choose which companies to invest in? You might wonder whether to invest in big names like Apple or Disney, or perhaps in energy giants like Shell. Warren Buffett, a legendary investor, advises that unless you're a financial professional, it's best not to try picking individual stocks. The average person typically lacks the expertise to select and time these investments effectively. Instead, Buffett recommends investing in an index fund, a more beginner-friendly approach. An index fund is a collection of stocks representing a market segment. In the US, a famous example is the S&P 500, which includes the top 500 companies in the country. Investing in an index fund like the S&P 500 means you're buying small pieces of many major companies. This diversification helps spread out risk, as you're not relying on the performance of one single company. The S&P 500 is a barometer of the US stock market's overall health. If the value of these companies collectively rises, the index goes up, indicating a robust market. In times of economic downturn, like a recession, or during events like the COVID outbreak, the market value can decline, which is reflected in the index's performance. Investing in an index fund is a way to participate in the broader market's growth without the complexities and risks of picking individual stocks. Platforms like eToro make it accessible for beginners in the US to invest in these funds, providing a straightforward way to start building a diversified investment portfolio. As a regular investor, one of the best approaches you can take is investing in an index fund like the S&P 500. Let's say you invest $1,000 in it through a platform like eToro. This investment is now diversified across 500 top companies, proportional to their weight in the index. For example, a portion of your investment goes into Apple, Microsoft, and even smaller portions into companies like Ralph Lauren, based on their market value. Warren Buffett, one of the most successful investors, advocates this approach. He suggests that most people, especially beginners, should invest in the S&P 500 or similar index funds. This strategy isn't about outsmarting the market or picking the next big winner. It's about spreading your investment across a wide range of leading companies, betting on the overall growth of the US economy over time. The alternative, picking individual stocks, is often less fruitful for the average investor. History and studies show that even professionals struggle to beat the market consistently. Most people who try to outperform the S&P 500 by stock picking fail in the long run. The philosophy here is simple. If you can't beat the market, join it. Investing in an index fund is a way to participate in the market's overall growth without the complexity of selecting individual stocks. But how do you invest in an index fund like the S&P 500? Well, you can't just buy it directly from a website. You need a platform, a broker, to facilitate this, and eToro is an excellent option for those in the US. It allows you to invest in index funds and offers features like virtual trading with practice money. This is a great way to get comfortable with investing concepts before committing real money. Furthermore, eToro offers innovative features like investment pies, where you can see and even replicate the investment strategies of finance professionals. These pies show allocations to different stocks or indices, allowing you to diversify your investment with a single click. Remember, the key to successful investing, especially for beginners, isn't about making risky bets on individual stocks. It's about intelligent, diversified investments in the broader market through platforms like eToro, which simplify the process and offer tools to help you make informed decisions. While I don't provide financial advice, the general consensus among experts is that investing in something like the S&P 500 index fund is a solid starting point for most people looking to grow their wealth over time. One common worry among new investors is the fear of losing money. It's natural to be cautious, especially when your hard-earned cash is on the line. Let's say you invest $1,000 in the S&P 500, and suddenly the market drops significantly, as it did during the 2008 financial crisis. Your investment's value might decrease, but it's crucial to remember that losses are only realized if you sell during the downturn. If you hold on to your investment, history shows that the market typically recovers and grows over time. This is the essence of long-term investing. It's about riding out the market's ups and downs and trusting its overall upward trajectory over time. It's like buying a house. Its value might fluctuate in the short term, but over 20 years, it's likely to appreciate. This principle applies to the stock market as well. Your investments in index funds or similar vehicles compound over time, harnessing what Einstein famously called the eighth wonder of the world, compound interest. The likelihood of all 500 top companies in the US dropping to zero value overnight is virtually non-existent. If such a scenario did occur, we'd face global crises far beyond financial concerns. Investing in the stock market is, in a way, betting on the collective effort and innovation of thousands of employees across these companies. They're constantly working, innovating, and creating value, which generally leads to growth in the value of these companies, and by extension, your investment. Regarding the amount needed to start investing, you don't need to be wealthy. Platforms like eToro in the US make it accessible for most people to start investing with a small amount of money. The key is to choose reputable and legitimate platforms in your country. Besides stocks and shares, other investment options like real estate and cryptocurrencies exist. Real estate typically requires a significant initial investment, making it less accessible for beginners. Cryptocurrency, on the other hand, is highly volatile. While I have invested in crypto, it's crucial only to use money you can afford to lose. Cryptocurrency shouldn't be seen as a get-rich-quick scheme, but rather as a high-risk, potentially high-reward component of a diversified investment strategy. In summary, if you're starting your investment journey, placing your money in a stock market index fund like the S&P 500 is a solid strategy endorsed by experts like Warren Buffett. It allows for diversified, long-term growth potential without extensive financial knowledge or significant capital. Furthermore, if you found this video helpful and informative, I'd love to hear from you in the comments about your most significant concerns with investing. Remember to like, subscribe, and hit the notification bell for more insights into making your money work for you. Up to this point, we've explored what some might call the slow lane of wealth building. Investing a portion of your paycheck into traditional assets like the S&P 500 and waiting for it to compound over time. This is a solid proven strategy, but it's not the only way. Let's shift gears to what MJ DeMarco in The Millionaire Fastlane refers to as fast lane investing. This approach focuses on more immediate and potentially more lucrative ways to increase wealth. Fast lane investing is about investing in yourself or your own business rather than just external companies. It's based on the concept that if you can improve your own skills and create a successful business, the return on investment can far exceed the average market return. For example, taking a course to upgrade your professional skills can lead to a substantial pay raise, quickly recouping your investment and continuing to pay dividends in the form of higher income. Similarly, investing in your own business can offer much higher returns than traditional investments. Starting a coffee shop, an online business, a YouTube channel, or learning to code and developing an app are all examples of fast lane investments. These ventures require more work and carry more risk than passive investments like index funds, but the potential returns are much greater. Alex Hormozy, a multi-million-dollar entrepreneur, contrasts investing in the S&P stock market with investing in the SME, small and medium-sized enterprises, i.e. your own business. The latter, he argues, can yield significantly higher returns because you're directly controlling the investment and its growth potential. For those interested in fast lane investing through creating content, like a YouTube channel, there are resources designed to teach you how to systemize and scale a YouTube channel as a business. It's important to note that only some need to pay for courses to learn these skills. Many free resources are available online, especially if you're starting and funds are limited. To dive deeper into the concept of fast lane investing, I recommend checking out my book review of The Millionaire Fastlane by MJ DeMarco. It's a valuable read for anyone looking to accelerate their wealth building journey beyond the traditional methods. Thank you for watching this video. I hope you found the information on fast lane investing insightful and motivating. If you want to explore more dynamic ways to build wealth, consider investing in yourself and your own ventures. Remember to like, subscribe, and hit the notification bell for more investing and wealth building content. Your journey to financial success starts right here, and I'm excited to be a part of it. See you in the next video.